Welcome, everyone, to one of the most fascinating moments of the year where we get to really dive into real estate, a market that's been on fire despite some concerns, even in areas that had been high concern spots, including the centers of big cities where everybody declared the office dead. And now everyone wants their employees to come back. Joining us today, I'm so pleased to say, Adam Schwartz. He is co-chief executive officer and co-CIO of Angelo Gordon, with many years of experience in the real estate market. And I'm learning that the real estate world is relatively small and everybody knows each other very well. Lauren Hochfelder also joining us. Lauren Hochfelder is managing director of Morgan Stanley, as well as the deputy chief investment officer at the Morgan Stanley Real Estate Investing Group. And there is this idea right now that there still are gains to be had as more people look to private assets and as yields remain low. Adam, Lauren, let's just start with a state of play of where we are. How much more value is there left? Is this still a hot spot for people who want yields? Lauren, let's start with you.
Sure. Look, I think it really depends on the type of real estate. As the prospect of higher interest rates come, presumably off the back of higher inflation, I think the tides are shifting a bit. In a low rate environment like where we've been, there's been tons of investor demand for long-term leased assets that provide current yield, some inflation protection, et cetera. And we've seen yields compress materially for these long duration, frankly, risk-off assets. But now as the world shifts and as we all sort of wake up to this prospect of inflation and rising rates, I think those assets with long duration leases are frankly more exposed, more at risk than other places, whereas other types are more resilient. We're focused on areas of real estate that tend to do well in inflationary environments where economic growth and secular tailwinds can outpace, can propel NOI growth that really outpaces interest rate hikes. So it really it depends, but we do still think there are opportunities where we can grow income more than cap rates should widen.
Adam, do you also see this as sort of a perilous moment for high duration?
Yeah, I agree with what Lauren is saying. I mean, I think, when you look at, I think the best proxy to look at is probably the fixed income market. And, the IG universe right now is basically trading at negative real interest rates, right? And the spread that you can achieve from buying real estate relative to buying, whether it's IG or high yield, it's pretty attractive. It's probably actually the most attractive that it's been since the 90s. The metrics that we look at would tell you that real estate, if you wanted to get to parity to sort of the long-term averages of fixed income in terms of the spread to fixed income, that would tell you probably real estate has another 20% of price appreciation. We don't necessarily believe that you're going to capture all that, but it looks very attractive on a relative basis. And there's, as Lauren said, a lot of dry powder sitting on the sidelines trying to get some yield. If we do get inflation, even better for certain types of real estate. So yeah, I think you want to watch out for those long duration, fixed asset, fixed income type real estate assets, but those that are shorter duration have more upside, we believe.
And just to clarify, Lauren, when you talk about long duration, you're talking about leases that go for a very long time. The idea that if there are a lot of sort of properties, spots within a building, per se, that are extended out for a long period of time, is that long duration, or is there something else that also counts as such?
No, I do mean long lease duration. And I think in particular where there's no material CPI indexation, so where the income stays flat as rates rise.
Yeah,
so let's dig into some of the specifics.
More. So I was just going to say, Lisa, certain asset classes will do better in an inflationary environment. Those short leases, think of hotels or apartments where you're leasing them by the night or by the year. You're able to capture that inflation much quicker than a 10-year industrial or office lease.
Well, let's go there, because that sounds counterintuitive at a time when hotels are still struggling, certainly in the big city areas. Where are you seeing opportunities within the hotel sector, within the leisure industry, especially in areas that have relied on historically at least, on international travel?
Well, you nailed it. I mean, it is leisure. It's not corporate. It's not group travel. So we've been more active in that space. We bought the Four Seasons in Vail, Colorado, last year because we thought that, in an environment where people were not traveling internationally, where domestic and drive-to destinations were going to become more popular, that those types of assets would benefit. And so we're definitely seeing that, on the corporate side, on the group travel side, convention, where, there's a long way to go. I think it's going to be a couple of years until people really get back to traveling the way they used to, if they get there at all.
Lauren?
Look, I agree with Adam. I think the question from here, though, is many of those drive-to leisure assets have appreciated pretty materially. I think, 18 months ago, 12 months ago, Adam and I might have been chatting and said, gosh, this is going to be this great opportunity for distress. And the reality is pricing has accelerated because of the trends that Adam referenced. So now we look at, is that fair pricing, or are the capital markets ahead of the fundamentals? And I think it just depends by market.
Adam, I want to dig into something that you said, which is you're looking at leisure, not necessarily business. So how do you know when you're catching a falling knife if you try to go into some of the hotels, some of the convention centers at big cities, versus actually finding value, given the fact that there actually is serious uncertainty about the outlook?
Yeah, I agree. Listen, there is uncertainty, but at the same time, we are paid to unlock value and find value. And, there are certain markets where in a normal environment, it is extremely hard to buy and hard to penetrate those markets. So, as an example, we recently bought a hotel in San Francisco, which, so far has been very slow to recover. That being said, do we believe San Francisco in the long term will recover? It's a hub of technology. Do we think that there will be groups getting together there? Absolutely. We think there'll be travel. And we were able to buy something at a basis that we thought made a lot of sense. So, when you can identify an asset that you think is attractively priced, discount to replacement cost, sometimes you have to take that leap when the market is not there and assume that the business will come back, which we believe it will.
Lauren?
I agree. It's really those moments where the market throws away the baby with the bathwater. And for assets in particular, like hotels, where you're not buying this off of current income, it's all about sort of your perception of where RevPAR, where income will go. Buying at the basis is everything.
So let's talk about the other areas in cities, in San Francisco, in New York, big cities that saw the office market absolutely decimated. Lauren, is this an area of opportunity, or is this an area of transformation that perhaps people have not fully priced just because rates have been so low and there has been such hot demand?
Yeah. Look, I think it's really not one size fits all. You're already seeing this wide dispersion in performance across different types of assets, also different types of markets. But, there are certainly, I'd expect that you'll see meaningful devaluation for commodity product in some of these markets that are more susceptible to work from home. In certain segments, those that are more exposed to functional obsolescence, where the CapEx needs are so enormous that your real yields are, frankly, lower than they may look on paper, and expenses growing, et cetera. So you can paint a bleak picture for certain segments. On the other hand, in stark contrast, the best quality assets in the better markets are at all-time high rents, all-time high values. And I think it's ultimately comes down to companies that are performing well, who want their employees back into the office, are investing in high quality office space. And there are still a lot of companies that have strong performance in this environment and are making that investment. So you really just see this barbell. I think in real estate, we spent the last decade plus talking about sort of the bifurcation or barbelling of A and B malls. And I think we're starting to see that transformation in office as well.
Adam?
Yeah, I agree. I mean, we do not believe that this is the death of the office building. I think businesses and individuals get tremendous benefits from working together, not working from home. Collaboration, the culture building, the mentorship and training that you get. I think it's extremely important. I think employers recognize that. They view their office as just one of the tools they have to attract employees. Some people talk about the technology sector where they're maybe showing more flexibility towards working from home. That being said, Google just made a huge investment in New York City. They just bought a building that they haven't even taken occupancy of for $2.1 billion. So they're clearly signaling that they believe in the future of the office. They believe in the future of New York City, as do we. The whole concept of companies taking 20, 30, 40% less space because people are going to work from home certain days. I don't really think that's going to happen. I think that, people want to be together. They want to use the office as a focus for collaboration. Well, if you're going to collaborate and all come in on the same day, well, then you can't rotate and squeeze out those efficiencies from sharing desks and rotating. So I just don't see it. I think, when you look at office space as a cost for a corporation, their rent is typically in the range of 5 to 10%. That's probably a pretty typical level. If you're able to squeeze, 20% efficiency out of your rent, you're talking about saving 1 to 2% on your expenses. Are you really going to do that if it has a material impact on the quality of life of your employees? I don't really think so. But I do agree with what Lauren said in terms of
every real estate official who I speak to or executive, they're all in the office. They all have been in the office, I will just say this, for months. So I don't think it's a complete coincidence, but it is notable to me, and your offices look great. I want to move on to warehouses and industrial spaces, because that has been a really hot area on fire. Record prices, people looking to transform C-level malls into warehouse space or something else like that. And I wonder if some of the value or all of the value has really been eaten up given the sort of competition and the vogueness, if I want to use a Tom Keenism, of this space. Adam, do you think that it's overheated?
It is certainly hot. Right. I mean, and it's been driven by e-commerce. E-commerce is booming through COVID. But not only that, I mean, you're seeing a lot of users of warehouse sort of shift their mentality and sort of, change from what was a just-in-time sort of supply chain process to maybe a just-in-case supply chain process, because with the challenges that we're seeing on the supply side, people want to hold more inventory. Stores don't want empty shelves, and there is a need. You need a home for that warehousing in the interim. So we just see continued demand there. Every square foot that gets built seems to get leased these days, but pricing has been extremely high, to your point. But again, it's a function of, if you think that inflation is going to come and you can reset those leases to market rents, people are willing to pay low yields to capture that upside.
Lauren?
Yeah, I agree. Look, I mean, we need to ask ourselves this question anytime we see this magnitude of an acceleration in returns. Industrial returns on an unlevered basis have increased by over 23% trailing 12. That is, that's a staggering level. But when you dip below, as Adam alluded to, a lot of that is the direct result of real strength and fundamentals. I mean, rents are up 10% plus nationally over the last year, and in many of the coastal markets in which we invest, 20 to 30%. So you're seeing sort of real strength in the numerator there. But look, admittedly, I think the other thing you're seeing is that significant yield compression, right? Cap rates have compressed, 110 basis points. And when cap rates are this tight, that's a pretty wide margin of compression. And I think obviously that's driven by a bet on the continued rental growth that we're talking about. But truly, I think it's also a narrowing of the universe of what real estate investors want. So you look back in the 1980s, for example, and 3/4 of private real estate investment was into office and retail. Those are not asset classes that investors want quite as much today, right? That is 50% today and probably trending down. So whenever you narrow the aperture of what investors want, that obviously drives up liquidity and pricing for the assets that fit the box. So look, we've had huge conviction around industrial, and it's been good. And I think to the extent, or I think for us, what we like to do is position ourselves where we can really create that product, manufacture that product to sell into that deep well of liquidity there.
Okay, when you say manufacture that product, are you talking about converting C-level malls? Are you talking about building new buildings? What are you talking about, Lauren?
Yeah, sometimes it's often building, it's often repositioning last mile product, so upgrading it for modern tenant demands. It's, look, there's a lot of talk about converting C malls, but there's a lot of, let's call it complexity to doing that in terms of how the rights work with surrounding tenants and a variety of other factors of re-entitlement.
So Adam, shifting to retail, where is the value at a time when you have a gradual shift away from retail, as Lauren was describing internationally for capital? And as frankly, in some ways, we're redefining what retail is to more of a warehouse kind of hybrid model with some sort of pretty storefront.
Yeah, it's a very tough question. I think we're going to continue to see evolution in the space. The stuff that we've been focused on has been more necessity, right? We're staying away from things like B and C malls. I think a lot of the concepts are just not very interesting these days. So we don't really believe in the future there. What we are seeing a tremendous amount of activity in is what I guess people are referring to as these dark stores. And these are sort of these immediate fulfillment companies. You're hearing names like Gorillas and GoPuff and Joker. These are stores that are leasing very small footprints, but very accessible to population centers. They're stocking those facilities with 2,000 items compared to the 10 to 40,000 items that a traditional grocer would stock, and they're trying to deliver those in 10 minutes upon demand. Will the business model work? I don't know. They're leasing a ton of space right now in urban environments, so we'll see how it evolves. But for the most part, we've been focused on sort of that necessity segment rather than just the traditional malls and generic commodity retail strip centers.
Is there more opportunity, Adam, in actually investing in an existing structure, or is it more retrofitting? As Lauren was talking about, the potential there that is complex, but potentially could reap pretty big dividends if the materials prove to be valuable, because it's hard to get these things, and building right now is expensive.
Yeah, building is expensive. So I think that to the extent that you can reuse what's there, that's great. The problem is, as we know in retail, there's just too much of it. There's way too many square feet per capita. And so a lot of the future of, that incremental retail space is going to be alternative use, right? Going to either residential or warehouse. I think what you got to focus in on is the sort of, supply constrained urban locations, or those key centers really accessible to the population.
So you mentioned residential, and I know both of you do focus mostly on commercial, but one of the hottest areas has been rental homes, buying up rental homes in bulk. And we've seen this, talking about what's hot and what's not. That's very much what's hot, to such a degree that it's become a growing presence and, frankly, push for the prices ever higher. Lauren, how much do you get involved? How much do you step back? Is this a better time to buy or to sell in the rental home footprint?
Sure. Look, we have been investing extraordinarily heavily in this space, frankly, across segment, so Class A down to workforce housing. And the bottom line is these are the strongest residential fundamentals we've ever seen in many markets. You have market rents above pre-COVID levels. I think it's in 98 out of the top 100 markets. So this is a strong market. And yields have compressed markedly as a result of that and as a result of the expectation of future growth. So now we sit here and say, okay, well, how much more can it go? I think one distinction is, maybe unlike other asset classes where tight cap rates, at least from a U.S. perspective, not sort of from a perhaps Japanese perspective, from a U.S. perspective, tight cap rates tend to be an indication of an expectation of future growth that's on the come. And I think residential, one distinction I'd make is these low cap rates, at least in part, reflect market rents that are already demonstrated. So a loss to lease, right? In residential, you're signing new leases every month. And so you have more visibility into what the on-the-ground rents are that you can achieve. So we can debate sort of depth of demand at those rent levels, but I think you have a little more price discovery. So with residential, look, supply will catch up. We've got a hole to dig ourselves out of, having not delivered a whole lot of housing for this country coming out of the GFC. But inflationary pressures should be, so long as they're moderate, good for residential rental. And I think the ultimate, risk will be the sustainability of these rental levels, because some of these markets are popping up against affordability constraints, and that's real.
They are,
Adam?
but at the same time, you look at the for sale market, right, and you're seeing home price appreciation of 20% year over year, just staggering numbers. So whether you're renting or buying, there is no affordable option. Add to that the fact that input prices to build are going up, right? Whether it's labor, lumber, steel, depending upon what you're building, everything's getting more expensive. So the rent to achieve an acceptable return on cost is going to go up. So it is inflationary across the board, whether it's for sale or for rent.
When you talk about the rent being too damn high, I do wonder, though, whether, Adam, first of all, whether you're investing in this market, and second of all, if there are certain segments of this market, I'm thinking of the Sun Belt, that have gotten perhaps a little over their skis simply because people have counted on this migration away from big cities to such a degree that it'll take years to prove it out.
Yeah, it's definitely something we look at, right? You got to watch the income to rent multiples because trees don't go to the sky, right? So what we've been trying to do to improve our yield has been building. We've been building more often than buying on the apartment space because we're just achieving better yields through doing that. And we're kind of, we keep scratching our heads every time we finish a project and then go to sell it because the yields that people are paying just seem to go down a couple basis points every month. We just sold an asset in Austin, Texas at a sub 3% yield. It's brand new. The rents are at market, where is the upside? Someone is betting on continued rental rate inflation and the fact that, they can finance those assets extremely well. The debt markets are wide open in real estate today. Borrowing costs are very low. So, even if you buy an apartment complex at a 3, you're financing it in the 1s, right? You're generating probably a mid to high single digit overall cash on cash yield before you get any inflation. The issue is going to be if you don't see that inflation and interest rates do move up, you could have some challenges there if you have to be a seller. If you have the ability to hold long and you're buying at these low rates and financing low, you'll probably be okay.
Lauren, what's your sense?
No, I agree. And I think Adam brought up a point that maybe is not talked about, quite enough, which is supply or construction cost increases, right? In many of these multifamily markets, some of the markets you referenced in the Sun Belt, demand hasn't tended to be the issue. The issue has been when supply has really caught up and leapfrogged demand. And I think the fact that construction costs have really skyrocketed to such a degree, replacement cost has increased, should be a mitigant on excess supply, which is supportive of asset values.
Just real quick before we wrap up here, I'm wondering what kind of returns both of you are expecting in the year ahead. Substantially lower than what we've seen, about the same, or more? Adam?
I would say lower than what we've seen. But Lauren, what did you say, 13% year-over-year growth, roughly?
I think I said for industrial, 23%. So
23, okay. Yeah, I would say lower then.
Okay, so lower, but are you talking like 22%? Are you talking, we're going to go listen, much lower?
Again, right, we've got 10-year treasury at 1.5%, inflation running, whatever you want to call it, high 2s to 5%. 5% is probably not the run rate. Is high 2s the run rate? Probably. We think rates are going to go up. I think the rental growth will offset the fact that yields are going to go up, meaning multiples go down. So I still think valuations are probably positive over the next year, but I think it's single digits if you had to pin me to a number.
Yeah,
Lauren, you agree?
The last 12 months have had pretty stunning returns for industrial, residential, life science. We think that there's still positive return from here. I agree, high single digits types of returns, but I think, some deceleration is probably the right base case assumption.
Lauren, Adam, thank you so much for taking the time today. We really appreciate it, and have a great rest of the week and weekend. Take care.
Thank you so much.